See me? Awesome. We should be live. I have no idea if anybody has come. We have 23 people. Okay, awesome. Fabulous. I'm hoping this is getting recorded, so it's going to be fun if it's not. This is the first time we're trying this, so if you can hear us or can't hear us, on your right there's a little chat window. You can probably type in if everything's okay. Okay. Are we on? Okay, I can see a bunch of people. Awesome. Okay, great, great. Sorry for the complicated stuff around. Yeah, it's a little dark out here. We haven't got the lighting well done, but don't worry, this will move substantially. Can you see me? No, cut the light on that side because then we'll probably get this thing to be lit more. No, no, not that one. The window. Is it any better? No, that makes it worse. Okay. Okay. Got to figure out how this light thing works. We need a more, spotlight and all that stuff. But since you guys can hear, hi guys. This is our first edition of something new that we're trying out with Webinar Jam. This is a new software we picked up. You won't see my face for too long. Hopefully, we'll have some better stuff happening with respect to just the presentation and some screenshots. I am a disciple of Bon Baba. Bon Baba has told us that he will not be able to make it to this meeting, so we will take his message across to the world. And today that message is that capital gains is better than interest income. And why, we will explain through the webinar. We will be receiving live feeds from Bon Baba through this, and we will tell you exactly what he has to say. Just as a disclaimer, firstly, Bon Baba is a fictional character we have created, so please don't take any of this more seriously than it should be. You can't vote for him, you can't meet him. We have no other way to contact him other than the fact that he contacts us. We'll go through this webinar. It'll be probably an hour, maybe a little longer if we are able to if we are able to complete this session. We should not have any interruptions with respect to voice this time. What I'm going to do now is I am going to shift over to the presentation, and I'm going to reduce my phone volume to 0 so that you don't get interrupted. And we are going to go through the entire presentation. I was waiting for a couple of minutes until everybody joined in, but I think we should have everybody in now. So let's now start with Bon Baba going online. Give us a second before we move. We'll switch to the white window now. Okay, I'm sorry, this is a little bit of a complication, I guess. We've just tried to figure this out. Okay. Yeah. Now we're moving on. Okay, we are live. If anybody has any issues, just let me know. Okay. Okay, is everybody able to hear? अच्छा सुनाई नहीं दे रहा है? Is there no Vashisht is a male, don't worry. He's not the born Baba, we're all disciples. Can you guys hear me now? Okay, I'm just going to quickly run through this. Is everybody able to hear me? Okay. So I'm gonna run through all of the. No, sorry, my mic was on. Is everyone? Hello. Hi. Okay. This should be better. I'm so sorry. I shouldn't scream. Okay. Can you guys see the screen now? We should be able to see only my screen. Yeah. We should. This echo will vanish now. So I'm just going to quickly run you through the presentation. I'm sorry for these things because we've been trying a new setup, trying to test this out. First thing we'll speak about is about buying bonds on an exchange. One of the important things to understand is we've done this before, we've talked about it in various places. If you're a premium member, you probably have seen us talk about it on Slack, and we've done a bunch of emails on how it can be done. We'd like to talk about how choosing a bond based on how it returns money, whether it's in capital, whether it's capital gains or interest that it returns, changes substantially your net return. And finally, we'll take some examples. We'll talk about we'll talk about a record date conundrum and how you can offset capital gains. I'm going to go through this. I hope everybody's able to see it. If you can't, just holler. Here's how it goes. Okay, assuming all of you can see this. If you can't, I'll just tell you about this. From a different point of view. You can buy bonds from the exchange on the NSE or on the BSE. You can see the recent, for an example, the recent oversubscribed Edelweiss non-convertible debentures or bonds on the screen. There's a small difference between debentures and bonds. I won't go into that in any detail, but consider that for the most part, debentures are approximately equal to a bond. A bond is simply something that we put in money, they give you your money back. Sometimes it's an interest rate per year. They say, I'll give you, you give me 100 rupees, I'll give you 10 rupees per year. That 10 rupees is called a coupon rate. And if you see something else called no coupon or zero coupon rate, it may be something like saying, I will take 100 rupees today from you, and in 6 months I'll give you back 108 rupees. That's effectively 8% in 6 months. That's the kind of interest rate I'm actually getting. So effectively, a bond or an NCD is just a fixed income instrument. We are most familiar with fixed deposits. The bank tells us, 6% a year fixed deposit, 7% a year fixed deposits. That's what we're going to look at bonds as, except they're tradable on the exchange, you can buy them. The problem really is that you don't really know what you're getting when you see a price of 1004 for a bond like this Edelweiss NCD. And I'm going to explain how that works. I know many of you probably know this, but I will run through this process just as an introduction. The terms of these non-convertible debentures are on the left-hand side. That's something that I've taken out from the actual offer document. There are 7 different forms of this particular debenture. There's effectively seven different debentures. What we were looking at on the right-hand side is number N6. So N6 is effectively, in this case, the 6 portion. So if you looked at the 6 portion of this particular non-convertible debenture, that's what it would be. The sixth version actually has a 10-year tenure, which means you're going to get your money back, your principal back, only in 2026. I think it's 10 years from the time you get in. It's 120 months. Also, it gives you a coupon of 10% a year. That means it's going to pay you 10% of whatever you invest per year. It's not of whatever you invest per year, it's of the face value. The face value, as you can see, is 1,000 rupees. That's in the 3rd or 4th row from the top for the 6th column. Now, you've got this as a non-convertible debenture available to you on the exchange for 1,004 rupees. Now, how do you value what 1,004 means to you today? What else does it contain? It says, for instance, on the right-hand side that you have a maturity date of 19 July 2026. You have the next interest payment date on 19 July 2017. So that means you're going to get paid an interest of 10% of the face value. That's 100 rupees. Face value is 1,000 rupees, 10% of that is 100 rupees. You're going to get 100 rupees paid out to you on the 19th of July 2017, which is approximately 11 months and a few days from now. And then you'll get the next one on 19 July 2018 and 19 July 2019 and so on till 19 July 2026, when you get the 100 rupees plus your principal back. So we will show you how the cash flows work. So you look at the cash flow. Now let me go back a little bit and show you something that's on the right hand side, which is, you see the buy and sell prices. This was taken at about 1:30 today, 1:22 p.m. The prices for buying were 1,004 rupees 55 paisa. That's the best buy. So if you wanted to sell this bond, you could only sell it at 1,004 and 55 paisa. That's where there was a buyer for 20 quantity of this share, of this NCD. The sell side, which is the best seller, was available at 1,004 and 86 paisa. It's just about 40 paisa difference between the two. 74 shares or 74 NCDs were available. That means about 74,000 rupees was available. So you could buy it at 1,004.86. Now let's go to the next side and see the left hand side cash flow. So if you see the cash flow, you will actually notice that that you could buy at 1,004 rupees 55 paisa. Assume you bought at 1,004 rupees 53 paisa. You would then get from your first interest payment about yes, I will mail everyone the NCD page. This will also be available, by the way, on YouTube later today as a recorded video. We will send you the email of the recorded video link. So on 19 July 2017, you get 100 rupees. On 19 July 2018, you get 100 rupees, and so on. So if you go down all the way, you see that this is 1,100 rupees coming back to you on 19 July 2026. This effectively gives you a a 10.006% return. How did we get that? There's something called an XIRR formula in Excel. We use this, we give it all the values. Minus is where you have paid money and plus is where you have received money. That's just you can switch it yourself if you like, but I say minus is when money goes out from me and 100 and plus is when it comes to me. So a cash flow is minus, it's going out today. I just put 8th August as an example because the next time you can buy this is on Monday morning. You have 100 rupees coming to you from each of these dates, and you get this at 10.006% is the yield you can get this bond at if you are able to purchase it at 1004 rupees 55 paisa. This is effectively equal, I mean, it's sort of equal to fixed deposit at 10%. There's some differences because fixed deposits sometimes tend to get compounded quarterly. So you actually effectively get interest and it's reinvested on a quarterly basis. Sometimes it's on a half yearly basis or 1 year basis. So the yield which would be effective for the same period for a fixed deposit giving you 7%, 8% quarterly would be about 8.15 to 8.2% using the same XIRR formula. So you can assume that this is like a fixed deposit that is annually compounded at about 10%, except for one thing. There is no compounding. You are given the interest, it comes to you in your pocket. This money is not reinvested back at 10%. So it's more like a cash flow instrument that gives you this non-compounded in a way interest rate. Your yield on the right hand side, I have a bigger box which says the same formula that's on on the cash flow basis for the ask, that was 1486. You can see that here you got 9.988% as the yield calculated at the same time. Okay, where do we get the left side dock on the, that's a question that was being asked. I think Amit has asked this. You know, it's complicated. Let me show you how it works. If I can share my screen again with you. Let me just go back in there and I am going to share a different screen which has well, I'm sorry, I'm just going to share this other screen with you and it's not visible. Sorry, I'll just share a new browser window and let me just share the new browser window with you. Hang on, here you go. Can you guys see this? I don't know if you can. I'll show you how to do this. So we go to SEBI's website, and what we're going to do is go to their, well, we have a bunch of things called debt offer document, and we're going to see the final one filed with the ROC. What this will do is actually show us the list of stocks, list of bond debt offer documents that have been placed with the registrar of companies. I'm not sure if this is something that's visible to you. I seem to see that the SEBI website unfortunately is very flaky. So you have to actually, you know, kind of Bond Baba has to give his I guess Ashirwad, and only then the site seems to come online. But if you go to those particular places and search for them, you will actually see the document that you need. You'll have to know when the document was issued. You'll have to search for that day and month. I can't seem to be able to get it. SEBI site seems to be down from my end. So I'm going to just shift back into so we're going to shift back in here. Okay, so I hope that is something that is clear. I mean, if it's a problem, I can always show it to you at a later date. Okay, so now let's go back into this NCD, or in a way into the cash flow document. Now we know how we get this cash flow. That's the first part of this presentation. Now we've seen this. This is the same Edelweiss presentation, right? Edelweiss bonds. They have a bunch of bonds. 1, 2, 3, 4, 5, 6, 7. Check out this option number 2. Okay, here you go. Option number 2, it's a coupon for NCD holders, but there is no coupon. It's NA. Why is there no coupon? You put in 1,000 rupees, are you not going to get any money back? No, the answer is go down further. You will see that 36 months from the deemed date of allotment, and let's pause for a minute until this jet passes by. Okay, we've got a return of 1,313 rupees coming back to us. That means if you put in 1,000 rupees at any time on the 36th month, that is what is 36th month? 19 July is when it was issued. So 19 July 2019 is when you will get 1,313 rupees. So that's the interesting part of this NCD. Why is this very different? There's no coupon. You're not going to get any money. Okay, so let's see how that works. Same thing, I'm going to look at the prices. This is a very illiquid in comparison NCD. The best buy is available at 995. The best seller is available at 1004. This liquidity will change on a daily basis. There'll sometimes be more buyers for this, more sellers for this at different times. So you have to look at the liquidity carefully, but this is available to us at 1004 rupees that we can buy it. Let's say we buy it at 1004 rupees. How much do we get? Now look on the right side for the calculation. Okay. First thing, 5th August, that's today, you put in 1004 rupees. It's gone from my account, so I'm saying minus 1004. 19 July 2019, I get back 1313. I use the same XIRR formula, I make 9.51%. Now this bond was issued at 9.5%. 19 July, you paid 1,000 rupees. You got 9.5%. The same formula, if I change 5th August to 19 July 2016, I would have got for 1,000 rupees by 9.5 rupees. What's amazing is in just 15 days, I am paying more rupees than you paid 1 month ago. And I am getting a higher yield, 9.51. You got 9.5 when you invested on 19 July 2016. That means you invested about 15, 20 days ago, 24 days ago, and you got a yield of 9.5. I invested 4 rupees more than you, and I got a higher yield than you. This is the power of what's happening with time. Bond Baba gives you the time answer, which is every time, the more time you wait, the better your returns are for the same price. Now the price needs to go up. So if the price went to 1004, you make 9.51. If the price is 1005, you'll make 9.52 perhaps. We can do this calculation on Excel as well. Let's now see what's really interesting about this. 2019 is 3 years away. According to the Income Tax Act, you can hold a bond only for 1 year. After that, it becomes long-term capital gains. You're getting 1,313. This is a capital gain because you invested 1,004. You're going to get back 1,313 rupees. They are not paying you interest. They're paying you a premium of sorts, and this premium is considered a capital gain. Since it's more than 1 year, and only bonds can be held for 1 year before they're called capital, long-term capital gains. For mutual funds, you have to hold them for 3 years before they can be called so. So bonds are in that way a little bit better. So you've held this bond for nearly 3 years. You bought on 5th August, sold on 19 July 2019. So it's 2 years and 342 days approximately. So you've basically now got long-term capital gains. In long-term capital gains, you can index for inflation. I assume inflation is 5%. Everybody's great, happy, crude prices are low. All this while, only 5% inflation. Your purchasing price from 1,004 becomes 1,162. And I'll show you how that happens in the Excel formula. Essentially, if you consider 5% inflation every year, 1,000 will become 1,050 in the first year. 1050 will become 1100, and so on. So 1162 is compounded 5% from 1004 in 3 years. Therefore, your index profit is 1313 minus the new purchase price, which is 150 rupees. There is a tax of 20% on this profit. You can choose to use that. So the Income Tax Act currently gives you a choice between 20% of indexed gains or 10% of absolute gains. Absolute gains in this case are 1313 minus 1004, so about 309 rupees. And the non-compounded, rather the non-indexed, the index gain itself is only about 150 rupees. So if I take the two, I get, sorry, hang on. Yeah. So we get about 30 rupees in both cases. So I can choose the lower of the two. So in this case, I choose 30 rupees 14 paisa or 15 paisa. My profit now is actually 1282. I mean, my return is actually 1282. I take the 1313 I get, I pay this in taxes, and I take my net return 1282. Net of this, and I do the XIRR formula again, my post-tax return is 8.65% per year compounded for 3 years. This is much better than any of the tax saving bonds you're getting, which is currently available only at about 6.4, 6.5%. And there's a good reason for that, is that these bonds are by Shriram Transport. Those tax-free bonds are by IRFC and NHAI, which are considered much better. SEBI page is okay. I'm just going to check the chat. I'm assuming all of you guys can hear okay. We have like 3 people on this right now. There's Vashisht as well, who's monitoring it. He'll be in soon. So we are in sense we're going to get, he's relaying the messages of Bond Baba from wherever Bond Baba is. Now, Bond Baba tells us also that your post-tax return on this bond, just because it was a capital gain and not an interest. Interest income is charged 33%, remember, up to 33% on your income. So you can go, let's assume 30%. So the return that you will get if you get something like 10% is actually 7%. Versus in this bond, you're getting an 8.65%, which is a fantastic return. Let me just quickly switch you into the bond, let me just see if I can do this reasonably fast. I'll show you the formula on Excel if that works for you. We've got this, and I'm going to share my Excel formula. Here you go. Okay, this is the Edelweiss. I hope you can see this. I'm going to raise the, okay, here you go. So this was the N6 bond which we saw earlier. Essentially, this was an XIRR formula. If you can see this, this is the formula. This is XIRR of, well, I'll put this here. So this was an XIRR of these versus these dates. That's what gave us 10.02, 10.06, and so on. Now, look at what we did with the taxation. The inflation is 5%, so my purchase price is actually So you've got the purchase price into 1 plus 0.05%, 1 plus interest rate to the power of 3 number of years is your new purchase price. That's how inflation indexation works. And then you can't just use 5%, by the way. The income tax actually gives you an index to be used, but I'm assuming 5%. The purchase price is this, profit is here, and so on. So you got this one, which is an XIRR of the 2 post-tax values, which is what is 8.65%. Let me switch back. I hope that part is clear. Um, so if I switch back to the presentation, we should be able to now see. Okay, here you go. Uh, we should be able to see now that many such bonds. In fact, there's so much that exists that says there's Shriram Transport Finance. Shriram Transport Finance actually has such bonds which don't pay any coupon and pay a big amount at the end. That is only a bigger payout that comes for individuals and a smaller that comes out for non-individuals. Edelweiss, as you've seen this, you need to check the prospectus that's going through SEBI and doing all that stuff. Now, a quick note, I think Naresh has a good point here. There are two questions. I'm going to stop here. Okay. First, let me say, okay, Shavej asks, can we check about the government gold bonds? The government gold bonds are more complicated in the sense that there is no fixed repayment. These are complex bonds in the sense I don't know how much I'm going to get paid after 5 years because I don't know what the gold price will be. The only difference is that you have a interest rate of I think 2.75%. I don't know. I don't remember exactly, but that's the interest rate that you will receive when you do when you redeem the bond. I mean, it on an every year basis. I think the bonds 2.75% is on the bonds issued face value. So 1,331 rupees, you get 2.75% of that every year. But when you get your money back, it will be linked to the gold price of the day you get your money back, not of the principal you put in. Um, but I won't go into much more detail. 2.475, yes. So we need to monitor. Do we need to monitor the credit quality of these entities? Absolutely. Why? Because Shriram Transport may be great today, Edelweiss may be great today, but what if tomorrow there is some problem? Uh, Being non-institutional, you will not get information about these bonds going sour. Sometimes they go sour in the interim of something. This happens to the best of us. It happened with Amtech and JP Morgan Mutual Fund, where despite like almost the whole world knowing that Amtech is not going to pay back, JP Morgan Mutual Fund was either unaware or even if it did get aware, the next problem, which I'll come to soon, um, which so a bond's credit rating can go sour in the middle. Now, what do you do if that bond rating goes sour? You first try to sell the bond because you want to get rid of it, get it away from your books. That's what JP Morgan obviously tried to do. But since everybody else knew that Amtech was not going to repay the money, Amtech bonds weren't going to be sold in the market. Nobody was going to buy them. What happened eventually was a distress sale where they said, listen, we paid 100 rupees, that's fine. Just give us 85 rupees back and we're happy. So somebody walked in and said, listen, I know how to recover the money from Amtech. So I will buy it back from you at 85 rupees. I'll give you 85 rupees. And then he might say, listen, I'll wait. I think Amtech is a good company. I'll wait for a couple of years. They'll return the money with the interest. So these things will happen, but as an investor yourself, you will not be able to do this because nobody will come to you and say, for my 5,000 rupees, give me 4,000. So what typically happens is the prices of the bonds start falling. So what you see as 1,004 today may become 850 tomorrow because that's all that somebody is willing to pay for those bonds. In a recent case in multimedia, their 100 rupee bonds or $100 euro pound, some one of those denominations bonds went down to 42 rupees, 42. So getting a 58% discount on those bonds. On the fact that somebody that kind of a discount. So value of a bond actually about sometimes company's credit rating than the credit rating itself. Agencies would downgrade, say an Amtech Auto in the last few weeks before it defaulted, whereas everybody else knew months earlier. But the other part of this equation is that in the institutional bond market, you trade something called a clean price. So 19 July was when that particular bond was issued. You will, if you assume that from 19 July to now, there would have been some accrued interest, right? So 100 rupees a year. There are 365 days in a year. So each day, approximately 28 or 30 paisa is getting added as interest into the bond price. So if I'm paying 1004 rupees on the 5th of August, that means I have about 12 plus 4, 16 days of interest into 30 paisa is about 4 rupees 80 paisa of interest every single day. Let me bring back the NSE page. Yes, oh, I'm sorry, I could have done that. Here we go. Okay, so I don't know if you can see this previous. Okay, I'm going to quickly show you this one. This actually shows you that this particular bond was on 19 July. The price is actually 1004. It's on August 5th, but the issue date was 19 July. So between 19 July and August 5th, it's actually accrued. Like I said, there's about about 4 days, 16 days, 16 days between the two. So 16 days of interest has been accrued. Assuming 365-day year at 100 rupees or 30 paisa per day, you're talking of an accrued interest of 30 paisa per day into 16 days, which is 4 rupees 80 paisa, which is why you've got a seller at 4 rupees 86 paisa, because effectively this guy is selling at par. He's got 4 rupees 86 paisa as the interest for the last 16 days. This is a dirty price in the sense you pay 1,486 and nothing else. The dirty price is because I don't know how much I'm paying for the bond itself and how much I'm paying for accrued interest. I have to calculate the accrued interest, back it off and say, oh, actually I'm paying 4 rupees 80 paisa for accrued interest and 1,000 rupees and 6 paisa for the bond itself. The bond itself means there's a yield to the bond. Now that's much easier to calculate because I could just run it on a formula that has something called a yield, Y-I-E-L-D in Excel. You can say, give me the clean price, give me the date of maturity, give me the interest payment schedule, the coupon rate, interest payment schedule is how many times you pay interest per year, and you tell me how much am I going to get at the end. I mean, it's what's the face value effectively and what's the price currently, the clean price. And then I will tell you that this yield of this bond is 9.5%, 9.6%, 9.4%, whatever it is. When you buy on a clean price, the price will show you something like 1001 or 1050 1000 rupees and 50 paisa. When you pay for the bond, you'd pay 1000 rupees and 50 paisa plus whatever accrued interest from the last interest payment date is. This is complex, but I just wanted to bring this together. I hope that part is okay. Yeah. So I'll switch from questions back on to the presentation. So let's let me bring it back here and okay. Okay. So if you have an interest paying bond, something can you do something to reduce tax? Now this is where Bond Baba's magic comes in. Okay, so you will sell the bond before the record date. The record date is, since let's say the interest payment date was 19 July. Now on 19 July, they need to know who to pay. So what they do is they say, okay, boss, 15 days earlier, I am going to take a snapshot of all the people that are out there, and I'll pay those people interest. So 19 July minus 15 days for 4th July 2017 will be a record date. On the record date, this same bond, 4th July 2017, this bond will probably trade around 1000 nearly 1,100 rupees. Assuming the interest rate, the yield doesn't change in the market, it still remains the same 9.5%. You will get this bond at about 1,000. I mean, you'll be able to sell this bond at about 1,100, maybe a little bit lesser because it's 15 days away. So maybe 1,095 rupees. You should sell it at 1,095. Next day, after the record date is over, you can buy it back again at 1,000 rupees. What has happened really is you booked some 95 rupees of profit, or 91 rupees of profit in this case, since you bought it 1004. What does this do? You will get a capital gain. The typical idea is that, boss, in a capital gain is exactly the same as short-term interest, because in the according to the tax department, short-term capital gain on debt is taxed exactly like is added to your income, except it is taxed at your income rate. Now, here's the interesting part. It's actually a capital gain, not an interest income. If the interest income comes in, it becomes interest income. I'll tell you what the difference is between these two in a short while. But as a quick note, before we go forward and before you start selling bonds before record date, remember that liquidity can be a problem. I mean, if you sell it at 1,095, what are the chances you'll actually get it back at 1,000 tomorrow? I don't think that is a question easily answered, because somebody may refuse, just buy it from you, but not sell it back. So this could be a serious issue. Now, let me just go and tell you what happens, or what the magic that happens. Now you got this capital gain. This capital gain can be offset. Now, the way the income tax department works is you have many heads of income. You have salary, and you have income from house property, which is like, if you put your house on rent. These are not two we're considering, we leave that away. The third and fourth are interesting, which is income from capital gains and an income from other sources. When you have an income like an interest income, it comes into interest income from other sources. You can't offset that income. You can't have a loss from another source easily. So you can have capital gains. In capital gains, you can offset your capital gains against capital losses. This is quite interesting because you have a situation where you can do bonus stripping. In bonus stripping, you will buy a company, a share of a company. Now, hear me out. You buy a share of a company before a bonus issue is actually recorded. So, for instance, right now, HPCL, that's Hindustan Petroleum, and Bajaj Finance have both announced that they will do a bonus issue. Both cases, I think, is 1:1. You can buy those shares. Now, what happens? Let's say you buy a share of a company at 1,000. This will become 200 shares because they'll give you the bonus, and the price will fall to 500. This always happens. It always falls to half. The second 100 is assumed to be at a price of 0, according to the income tax department. They say, okay, first one you bought at 1,000, that's fine. Second one you bought at second 100, you bought at 0. So you sell the first 100. You bought it at 1,000, you sell it at 500, you make a loss of 500 rupees. Into 100 shares is 50,000 rupees. Use that 50,000 rupees to offset against your short-term gains you made as capital gains in the bond, whichever the bond is. The remaining shares have a problem, right? You sell them, you'll be allowed to pay tax on them. But if you hold the remaining shares for a year, selling those will give you a tax of 0 under current laws. Even if it was not taxed at 0, selling shares after a year is a tax of only 15%, versus in the bond you would pay a tax of some 30-odd%, right? So effectively, selling shares even before a year or after a year would both give you much lower tax incidence. So you basically used bonus stripping to create a capital loss. You've offset it against a capital gain. Remember that only short-term capital loss in shares can be adjusted against capital gains in bonds, because long-term capital gain in shares, in equity, is not something you can offset against anything. Why? Because the tax department says, look, long-term gain in shares is not taxed, so long-term loss in shares cannot be adjusted, period. Because you're not paying tax on equivalent gain. So that's fine. So if you're held more than a year, then there's no point. What you should do actually is buy the shares now and sell it immediately after the bonus record date, and hold the remaining shares for a year after the record, after your purchase, and then you'll be fine. There are risks involved, and I'll go to those. But before that, let me also tell you another way. So the first way was to use short-term capital loss using bonus stripping. You can also use business losses. Now, business losses means like if futures and options income is considered a business loss. So you can use those business loss, which can be used to offset capital gains in the same year. That means a capital loss I've incurred this year can be adjusted against a capital gain I've made this year. So a business loss in this year against a capital gain in this year. That's allowed. But if I had a capital loss last year and I carried it forward, I can't offset that against a gain I made this year. This is a weird tax law. So you'll probably have some F&O losses. You may have been writing covered calls. In the covered calls, the stock may have been going up, and when it went up, it caused you a loss of rupees in the covered call. That's the short call option. But you made the gain in the stock, but you never intended to sell the stock, so you probably sold another call for the next month. But these losses are accumulated. These losses can be offset against the capital gain you've made in bonds. Also, we've talked about Brexit last time. We said, okay, how do you use your portfolio, calculate the beta, buy nifty options to offset against a fall? Brexit happened. Nifty didn't go down. You lost money on this hedge. You took it as insurance, so you're fine. You're saying, okay, Brexit didn't happen, that's fine. Brexit was at what? When Brexit was there, it was at 8,300 Nifty. Now it's 8,700. So you made back 400 points, which is 5%. You probably paid 2% for the hedge. You're thinking, dude, net of that, I'm still okay. I made 5% on my portfolio. But guess what? What you made on your portfolio is not something that you've taken the money out yet. You've not sold any stocks. So you've basically left it in there. It's looking like a mark to market gain, but you've not actually recorded the gain. According to the tax person, until it's recorded, no tax has to be paid. But the loss has been taken because you bought the put expired worthless. It gave you a loss of, say, 40,000 rupees. You can use that loss and offset it against a 40,000 equivalent gain that you made on a bond. And you can do this all year. So you already incurred that loss. You can take more bonds on now and make 40,000 and you will not have to pay any tax. So the good thing is you can offset these two. And you may have other business losses as well, which is if you run a business, a lot of accountants will be able to, offset a lot of your costs, including the depreciation on your car, including the electricity charges that you incur in having trading set up, your mobile phone charges. All of these can be offset. So as a salaried person, maybe you cannot offset because depreciation is not allowed, but your car and of your F&O income, and offset gains on bonds. What does that do? If you, I would say 10%, I would say 10%, 30% actually make 7%. 7% of losses in business losses or in bonus stripping capital gains losses, you make a net 10%. That's the power of doing this in different ways. So let me pause here. If there are any questions, you can ask away. Okay, there are some risks. If you have any questions, just go ahead and ask. I'll take them as we come along. One risk is the general anti-avoidance regulations that will come or may come into application from next year. 1st April 2017. They haven't yet announced it they'll have to announce it in the budget. The idea here is if you're doing a transaction only to save tax, then we will not allow it. But apparently, So you can always say that bonus stripping is a transaction taken only to avoid tax, because you never intended to hold all the shares for a longer term. So you did it only to avoid tax. Therefore, we will not allow it. This apparently applies only if you have income above 5 crore rupees. So for most of us, it may not apply. So that may be a lifesaver. For a larger portfolio, of course, this may not apply. So GAR is a risk. If you are doing bonus stripping, you have to hold the remaining shares for a year. What if Hindustan Petroleum fell to 500 rupees tomorrow? It's 1,200 today. You would lose all the benefit that you made on the fact that the share price of HPCL has fallen down. That's a risk. You can offset that risk in different ways. You can write call options, you can buy put options, you can do all sorts of things, but that would require your portfolio to be fairly large, because options will only be available at a portfolio size of at least 5 lakh rupees of gains. So you to get a 5 lakh rupee residual number of shares of HPCL, that means you should have bought 10 lakh rupees worth of shares. You will have a fairly large gain that you're offsetting. But this can be done. There is, if you don't do all of those futures options hedging stuff, you will end up buying shares which you've bought stripping. Therefore, don't buy shares. Bond Baba says this. Don't buy shares which you don't want to own anyhow. So HPCL is a good company, then buy it, hold it. You probably will make a good return in the longer term. Bajaj Finance is a great company. It's expensive, but given the fact that it's giving you this bonus stripping return and the fact that it's a good company, it's growing profits 45, 60, 50, 60%, even that may be a lifesaver for you in terms of growth in a few years. So don't buy shares which you don't want to buy. And the third thing is that you have liquidity issues. So liquidity issues is where you're doing stuff like this in large quantities. So you did, I said record date, sell before, buy it back. If you can't buy it back, or you don't think you can buy it back because there's not enough liquidity, you're selling 50 lakh rupees worth of shares, the total available market liquidity maybe only 5 or 6 lakhs, then you have a problem. Now at these points, you might want to get in touch with people like us. We can help you find a buyer who may be able to transact those for the intermediate period. And if you're going to pay 30% tax versus here you're paying much lesser, 20 or 15% tax, you will end up saying, okay, maybe the fee that someone else may charge for this transaction can be 1 or 2%, and that's still okay, which is something that we can try and help organize. We may not be necessarily the persons, we don't have that kind of money to be able to buy a large amount of shares from everybody, but we can find somebody else who will be able to warehouse those bonds for you and promise to sell it back to you after those dates. So get in touch with us if you're looking to do this. Okay, so Naresh, I asked a question. Before I go forward, I think I'll take this. How do you decide whether to exit a bond upon selling? Okay, this is quite interesting. Okay, I'll tell you one thing. I'll give you an example. Shriram Transport. Let me just let me just do a screen sharing of this so you can see what I'm talking about. Okay, so I'm going to stop this screen share and I'm going to go and open a screen share of just another window with perhaps, yeah, here you go, this one. I suppose you could see this. Okay, so I'm just going to open another tab. Is it visible? Yeah. So I'm just going to go to this particular bond. It's a PDF of this is the Shriram Transport bonds. Okay, so I'm going to just scroll down to a particular series which I want, which is Y4. Can you guys see this properly? So you have Y4. which has no coupon. Again, it's a very interesting bond. You go down and you see that NCD holders who are individuals get a yield of 11.25%. Why? Because on October 24th, 2016, they will give back the money. How much money will they give back? If you are an individual, they will give you 1,377 rupees 30 paisa per bond. If you are a non-individual, you get 1,358 rupees per bond. So if you are a non-individual today and an individual is willing to buy from you, now you're at August, this bond will mature in October. So we're talking August, September, September to October. So only about 2.5 months left. Whatever the price is today, I can buy it. If I buy the bond at 1,330 rupees, I will make 47 rupees if I'm an individual. But I will make only 18 rupees if I'm a non-individual. At 1,340, if I'm a non-individual, it actually makes sense for me to sell you the bond. Because making only 18%, that's 1.5% for 2 more months, is a waste of time. It's not much, it's only about 8.5% yield. Versus for you, 2 months, 47 rupees on investing 1,377 is 3% for 2 months. 3% for 2 months is equivalent to 18% a year. So there's a point at which I, as a non-individual, as a company or as an institution, will actually want to sell you these bonds. Buy them from me, and you see the 18% return and say, I will buy this. So typically, there is a point at which both the buyer and the seller are benefiting from having bought or having done a transaction. That is one level. Another level is to say, why would I sell a bond early? I might actually say, I'll sell this bond if I have met my return objectives. I wanted to make 12% on a bond. I give you this as an example. I bought tax-free bonds last year. From now going forward, tax-free bonds are only giving me 6.35%, right? So there I bought bonds which will mature in 2031. So I have to hold from now to 2031 to get a miserable 6.35% post-tax. Now I have all these capital losses and all these business losses that I can generate. And I'm saying 6.35% is not attractive. But when I bought, giving me 8% post-tax. Because of this, these bonds have appreciated more than 10 to 12% in value. So in the last 1 year, I've actually made some 13 or 14% on the bond. I'll sell it now. If I sell it now, actually I'm waiting for a year to pass so that I can actually sell the small profit and claim long-term capital gains. But assuming not that, assuming that I'm okay with this, I will actually sell these bonds today for this 10-12% profit and then invest the money into a bond that's going to give me 9% post-tax profit. I'm really that Shriram Transport is not going to default or go under in the next 3 years. 8.65% in the example I showed you, or Edelweiss, 8.65 to 9% in the example I showed you, I am get that post-tax versus I get only 6.35% post-tax with my NHAI bonds. That's another reason to objective has been met. Third big reason to sell bonds is you need the money. Why else would you keep your money here? I mean, if you're finding the liquidity and you want the money, this is the best thing to do. Many times the liquidity isn't available and we're trying to figure out how we can make it available for all of you. So do connect with us if you have particular bonds that you want to purchase at a certain price or particular bonds you want to sell at a certain price. We can help you make the market and connect you to the appropriate buyers. Let me go back now to the presentation. Here we go. We're going to stop this screen share and go back into the presentation. So, okay. So here you go. Yes. Okay. Now there's another risk that I haven't talked about. One of those risks is the fact that yields aren't easy to understand. Look at this NSE page. This was paged, a screenshot I took. Just earlier today. This is a bond called IRFC NO. Okay, the NO series was issued on 22nd March 2016. It was the last issue of a tax-free bond. You will not get any more this year because they are not allowed. Maybe in future years, but right now they are not allowed. The price was available at 11162 if you wanted to buy and 1114 if you wanted to sell. What is the yield? NSE doesn't even have it. That's because the formula they use, which does not really work very well with dirty prices. Dirty prices are these prices. How does that work now? I calculated this. Okay, so you look at the right. You have, okay, so here you go. So you have 1116, 1114. I took 1116. I just reversed the terminology here into I'm buying at 1116 is a positive number and the others are negative. It doesn't matter. You can use one or the other. So on 5th August, I buy at 1116. On 15th October, I get a certain interest rate, 43 rupees. What is this 43? It is the difference between the issue date, 22nd March, and the interest payment date of 15th October. So on these, we should subtract 76.4. Can you see this? Or are we lost? Lost. 1 second. Can you hear me? Okay, I'm going to just screen share it again. Okay. This is better? Yeah. Sorry about that. Okay, we're coming back here. We have 7.64% of an interest. That means 1,000 rupee bond, 7.64% is 76 rupees 40 paisa. Okay. Then we also have you paid 1116. You got 43 rupees in the first interest payment date. Then 76 rupees 40 paisa all the way down. And on 22nd March 2031. You get back 1033.07. If you do the XIRR on these, you get 6.68%. But nowhere is it mentioned here or here. Nobody knows what this means. So sometimes this risk is the lack of understanding of the bonds. You can pray to Bond Baba, but you have to do the Excel. That's the rule. If you don't do the Excel, even Bond Baba can't help you. You have to do the Excel. We're going to solve this problem, guys. We're working on something that's radical, and Bond Baba has given us the blessing to say we will show this to you without you having to run it through Excel and madness and record dates and all of this stuff. We will help you find the exact yield on every single bond that's available, and you can decide at that time whether this yield is good or not good. 6.68% for a 15-year AAA rated IRFC bond is good, not good. You don't know the answer to that question. If the answer to that question is I want it, then this is the place to go in and buy. Do not rely on the NSE gives you. The other thing that we've realized is if you're using a broker today, most brokers will say pay us money right now. A Zerodha will do that. Most of these online brokers will do that. You can't even buy a bond without the bond being in your account already. As a quick suggestion, what I would say is you should use a broker who doesn't charge you a percentage brokerage, because that is going to reduce your return. So if you buy a 6-month bond that's giving you 9% and your broker charges you 0.5%, you just lost 0.5% in the transaction. That means you got only 8.5%. Now you got 8.5% for the whole, you got 9% for the whole year. For 6 months, it's actually 4.5%. You still paid 0.5. You make only 4% now on this transaction. This is literally, you've shaved your return by 1 full percent. Instead of 4.5% for 6 months, you're now getting only 4%. So even with a discount broker, say at 20 rupees a trade, don't buy shares worth only 2,000 rupees, bonds worth only 2,000 rupees, because at this point 20 rupees a trade is 1% of your trade. You got to buy a reasonable quantity before you'll be able to buy it. So Zerodha or an Upstocks today may charge you 0 brokerage for buying stocks. but your transaction cost is not actually zero. It's a small tiny percentage of your total thing. So do consider that as your cost before you take on any of these bonds. At Bond Baba in Capital Mind, we have mentioned a number of bonds at different transaction types. We've got 4-month, 3-month, 2-month bonds. We've done 1 year, 5-year, 10-year bonds. So if your transaction costs are higher, just go in the longer end of the chain so that this transaction cost is spread across 10 years and not immediate. Um, so the last part, I suppose the connection should be back by now. The Bond Baba rule set is prefer capital gains to interest because you can offset it. You can sell and buy back bonds in a day, which is you sell them before the record date, buy them after the record date to get capital gains instead of interest. You can offset your capital gains um, by using bonus stripping. That's rule number 4. Rule number 3, I'm just going backward in the rule set, is that you can use long-term premium paying bonds rather than coupon paying bonds. Being coupon is where the interest is paid to you every year. Premium is where you pay once and after 3 years one big amount comes back. Number of bonds of these type exist. We will list them out. We'll send a bond handbook to Premium soon. Probably by end of August we'll have this bond handbook ready for you. This will be able to be used by you to figure out which bonds to buy. The last Bond Baba rule is don't stress yourself out, stay healthy, be fine. This stuff is great to uh, to actually solve your problems and shouldn't be used to create more problems for you. So don't do things that you don't feel comfortable. Bond Baba can only help if you do not panic. So that I think ends the set of questions that we have. If you're a trial member, to consider subscribing. We've got a bunch of things around this Uncle Theta, Bond Baba. Sometimes they meet each other and give us some solid discussions. We've got a bunch of, you can visit the subscribe page, or there's a get page as well. Cool. So yes, debt funds have returned about 9% CAGR. This is a question. Indexation over 3 years. Isn't debt funds better than directly investing in bonds? Answer to that is, if you want to, so in the last 3 years, a liquid fund has given 9%. So it was a great investment to have. We've suggested that as well. I've been investing in liquid funds as a means of long-term investment for the last 3 or 4 years. But going forward, these funds may not return the same amount, and some of these retail bonds are not what corporates or mutual funds get. Now these bonds are giving you 9-10%. The recent DHFL NCD gave about 9%. Or 10%, I think, 9 point something percent, even 10%. The Edelweiss NCDs had a 10% option. These are all typically bought by retail, not by institutions like mutual funds, because they can't get enough quantity of them. Now, these bonds and a number of others in the institutional market, they've seen a substantial drop in yields. HDFC, which used to pay about 8.59% earlier, maybe a year back, is now paying only about 7.85, 8.25%. Reliance Jio was able to place its bonds at 7.85% recently. A number of other corporates have seen a substantial fall in yield. So that means a mutual fund investing in bonds going forward is still not going to get this kind of quality of yields. They might, a Shriram Transport bond in the institutional market will probably go at about 9% now, maybe a little bit less than 9%. So what happens really is that the mutual fund itself, in order to make the same kind of a return, first of all, it hold it for 3 years. Second of all, they charge you a management fee. A typical dynamic bond fund charges you something like 1%, 1.5%, and they will give they will give you a net return out of this. So if they got 9.5%, you got 8.25% because 1.25% went in management fee. So if you're getting 8.25% post-tax, you might as well invest in a bond that gives you 8.75% post-tax. And remember also, debt funds are not tax-free even after 3 years. You have to index them. So there will be a small tax that's applicable on them also. So what was past was past. What is the future is what the yields mean in the market today. Institutional yields are much higher, lower than retail yields. So as a bond owner, retail person, you will actually be able to make better returns on your own. Um, okay, they were. Uh, there are more. There are more bonds in there. There is more questions. Okay, so we've got, okay, Vinay asked about listed infrastructure bonds trading. Yeah, the infrastructure bonds traded now cannot be claimed for tax benefits because they were only available for tax benefits, I think, on the year that they were invested. I don't know about this specifically. Maybe I should get some CA opinion on this. I have a feeling that you can't do. See, the point about this was some infrastructure company got the money to be able to use for infrastructure, correct? That's why you got the tax benefit. So somebody got this infrastructure thing, LNT or whatever, and it said, I will build some bridge or I will build something else. This is fine. So bonds, it took your money, it built some bridge, you got tax benefit, fine. Now it's 5 years later, the bonds are trading on the exchange. If you buy them today, the seller is not LNT, it's some random guy who held the bond. Say I held the bond. I am selling, I got the tax benefit, now I'm selling it to you. You now can't claim that tax benefit. Okay. Uh, so at times, Naresh asks, at times the bonds are initially locked, later they become, they become tradable. If you own them originally, then is it better to apply for redemption or wait to sell it? It will depend on whether you want to lock in a capital gain or an income that involves interest. Because if you sell it on the NSE, you may actually record a capital gain. If you sell it directly back to the company, they might just pay you. They may not pay you a redemption premium. If they do, that's capital gain. If they might pay you what is called accrued interest, and if you get accrued interest, it is capital gain. Uh, it's sorry, it's not a capital gain. It's interest income, other income. So that's one of the reasons you do. If you want to sell, redeem, wait for it to sell it later through the NSC. The answer is no. I mean, it's not black and white whether one is better than the other, but the steps required are complex in the sense you have to call the company up and find out what each bonds are a complicated beast. So every bond may have a different time period, a different mechanism for redemption. But typically, if you call them up, they'll give you there'll be a form which you'll have to just specify. Yes, Selva, I actually talked about the brokerage charged by brokers while buying the bonds. Uh, the idea is it does bring down your yield effectively. So you should, if you're getting charged a percentage brokerage or a high brokerage, you should look at only longer term bonds because then you can spread the commission across multiple years rather than taking it in the short term. Okay, in debt funds, are we not diversifying across various bonds? For the most part, yes. So if you think that, see, it's non-deterministic, you don't know how much you'll make. A debt fund can give you 10% return, it can give you 6% return. You have no idea of knowing. And the idea of a fixed income is like, the Indian, thought process, and perhaps it's not restricted to India, probably worldwide also, is am I going to get? So if I don't know that answer, then I'm taking some risk. The bond is also going to give you some risk. It's also going to give you a knowledge of how much you'll get. A debt fund, it's going to give you some risk, but it's not going to tell you how much you're going to get. So if you're comfortable with not knowing how much you're going to get, you're actually doing something that is of the order of risk level investing like equity. Because you see, after 3 years, it is not like the bond that Mr. Debt Fund holds is going to mature, and it's the only bond. So what will he do? He'll buy some 3-year bonds, some 5-year bonds, some 10-year bonds, some 8-year bonds. You want the money after 3 years, then at the third year, what if the prices of all the other bonds have gone down? Yields have gone up hugely in the market. Inflation was very high. Those bonds are trading at a much lower price. So you will get a lower yield because, or you lower NAV, even though you wanted to invest only for exactly 3 years. This is called tenure matching. If you're not able to tenure match, if you're okay with not tenure matching, then you're fine. You can just buy a debt fund, and we've suggested that in another video where you just buy even a liquid fund and take money out of it every month, and it's fine. It's not a very deterministic solution, but since you don't care about actually the risk of interest rates going up or down in the longer term, you should use that mechanism. But where you need a 10-year match, I need to lock my money in for 3 years or only 5 years. I'm not comfortable locking my money in much more than that. This is what we typically do in a fixed deposit, right? We say I want a term of 5 years or 3 years or 1 year. So when we do that, a bond is more efficient. Cool. It's been a 1 hour, 15-minute session, folks. So I think we've done a lot of talking. Apologies for having multiple things happen in the initial parts. We're trying to figure out how these things work, but we'd love to hear what you have to say. And how do you like this webinar? What do you think was good? What do you think was bad? Questions on the content, questions on the presentation. We will have a video of all of this made available to you. I'll send you the links of the actual offer document for Edelweiss, which is what I demonstrated earlier, and the Shriram Transport one if you like. If you have any other questions, please write in premium@capitalmind.in or deepakshanoy@capitalmind.in would be a great place to start. We will have a synopsis, of this on our website also. Subscribers, they'll be able to access the archives of this video anytime. And finally, I hope you're all able to appreciate what Bon Baba has to say, and if you have any contradicting or different views, we would love to hear them. So thanks very much for being here. If you do you have any questions? Would you like us to answer anything else? I think it's been a while, so I'll let you guys go. It's a Friday evening. Please enjoy your weekend, and I hope you start the next week with lots of bonds. And thanks to Bond Baba for giving us all this information. Thanks again. We'll catch you again soon in another webinar. Would love to hear your thoughts. Cheers. Have a fun time. Great. Let us close, end the call.